Good afternoon, everyone. Hope everyone can hear me. This panel is now going to be very, very easy thanks to Mr. 𝐵𝐚𝐽 laying it out that there's nothing to do in public listed markets anymore in India. I have been a part of his discussions over the last 15 years, and this is the most optimistic scenario he's laid out, right, for India over the next 5 years. So I think he's really optimistic if he's giving you a 0% return guidance for the next 5 years. So I would be very, very happy with his presentation. Coming to our panel that we have here, this is something that's very, very close to my heart, and I truly believe that in India, the allocation to alternates is less than 2% from ultra HNI family office wealth, while the same in the Western markets is close to 20-25%. A huge, huge headroom for growth, and I think we have three of the most interesting asset classes for you to consider. I'll just like to lay up some groundwork before we get into the discussion. It's also because I'm the moderator and I have the mic first. But yeah, so I've been an analyst in public markets and venture capital over the last 2 decades, so seen the entire spectrum of liquidity and data. What I thought I should do is address the 2 most FAQs that I've always got on closed-ended funds, right? The first, and I think it's very, very important, is illiquidity. The simple answer to that is, you have to be very, very careful about your allocation when you put in illiquid assets. But at the same time, do you know of any asset class where you can make returns consistently in 1 year? You cannot, right? So I think illiquidity is a good way to actually keep your money in the right time at the right place. And the second aspect, which about closed-ended funds, is the investor IRR and the fund IRR is the same. And I think it's a very, very important aspect. Going back to 2000, dot-com boom and bust, that was my first job selling mutual funds. And I remember I was 21 years old, and one investor told me that the IT boom came only for the funds and the bust came for the unit holders, right? That doesn't happen with open-ended, that doesn't happen with closed-ended funds because your fund IRR is the same as investor IRR. Great. With this 2 very, very important, I think, ways to look at closed-ended funds, let's dive into the panel. We'll start with a round of intros. Maybe we'll start from my far right. Amit, go for it.
Yeah, hi. Thanks. So I had the private credit at Aditya Birla Sun Life AMC. I've been with Aditya Birla Capital for around 14 years now. Prior to that, I was managing prop book for Aditya Birla Capital in special situation and stress asset investing. Prior to that, I used to handle an NBFC book in the project and structured finance space. So that's about me.
So good afternoon, friends. My name is Rohit Rathi. I'm working with ICICI Prudential Asset Management Company. I take care of real estate business for them. I've been in this real estate industry for more than 20 years, mostly with ICICI Group only. I was with ICICI Bank earlier, and now with ICICI Pru AMC. At bank, actually, I used to take care of developer finance and real estate financing. So I would have done more than 1 lakh crore of financing, seen 3 cycles actually in real estate in India specifically. And then I moved to AMC to manage investors' money rather than our own money. We find real estate is a very interesting asset class which need more better fund management.
Thank you. So, hi everyone. Good afternoon. I'm Vignesh. We run Artha 99 investment or A99 out of Chennai, India. So we are a manufacturing and infra-focused VC. It's a misnomer. So we are an early stage investor in manufacturing and venture cap and infrastructure opportunities. We are into our 3rd fund, which is a $100 million fund. So we believe the next decade of growth should come from manufacturing and infra opportunities in India in the alternate space. So that's what we do. And over to.
Thank you. Thank you so much for the introductions. I'll start this time from Vignesh. There are more than 2,000 companies listed in the Indian stock market. Why should someone look at investing in your fund? Or if I may ask this in another way, which parts of the economy that I'm not exposed to in public markets that I can get exposure of?
Okay, so you should give me money because we are very good. So without, apart from that, the fact is that, see, alternates, even if you have exposure to the public markets, right? I think alternates is a space that definitely everyone should consider, because the opportunity cost that you lose by not being in alternates is higher, considering what we heard from Mr. Sharma saying public markets are not going to be great in the next 5 years. I think alternates is a good space to keep your portfolio goals together. And also, see, even though we are a manufacturing infra and Nifty has got enough manufacturing infra companies, I think it is more about the quality of companies that are coming in, the kind of innovation they are doing in their respective field. So I think you gain exposure to these kind of emerging technologies and emerging innovations in these old segments by having exposure with us. I think I answered your question.
Yeah, this is very interesting. There was a very interesting piece of analysis put out yesterday that there were some 31 IPOs from the startup world over the last 3 years. Only 5 are above IPO price, 26 are below IPO price. And that's the reason why you should do early stage in unlisted companies, right? Because people like Vignesh have massive information asymmetry when they bring it to the public markets. And then we have the retail and some of the fund houses who are supposed to buy it because they are in the market. But most of the valuation is already juiced out by the unlisted players. Rohit, which are the most interesting sectors that you look within real estate, which are promising from a next 3 to 5 year basis?
Yeah, so first, what Shankar has told, actually in house we have a very strong view. See, asset allocation is the key in the next 5 years if you want to make alpha return in the markets. And in that, real estate can actually add as one of the important asset class. This asset class actually is largest asset class. However, in terms of financial world, equity and debts are typically the only asset class which we talk. And real estate, we just do for our personal references. We feel both residential and commercial has done very well after COVID, especially India. If I talk about numbers, residential, India would have sold more than a 5 lakh units last year. And in terms of office, more than a 50 million square foot have been leased. So out of these two asset class, say residential and office, we feel office is an asset class which will be an alpha return driver this time. You would be surprised to know in India, it's the highest leasing happened in last year, which is highest in even Asia Pacific. And there is a lot of movement of global GCCs to India, and the rental returns are still above 88%. So somebody can easily try to achieve with the leverage position between 15 to 18% return in this strategy. So we feel office strategy or rental yield strategy probably would be another alpha return generator in this markets, which can give a stable returns when when the public markets are having fluctuations.
Got it. Rohit, maybe a quick follow-up question from what you said. What is the most important thing to look for when you look to buy a rental yielding commercial property? What is the most important thing that you look for?
So let me tell you from an Indian perspective. See, since we are talking about Indian real estate specifically, see, India real estate, there are actually 3 parts for buying a property. First is the property itself, means it should be a grade A building, location in a micro market makes a lot of difference in a specific property. Second is today the preference of global firms or tenants are changing. That's not the same, or you cannot make the same old type of building and people will like it. So there's a technological change. People are going for sustainable and more uh, LEED certification buildings. So you need to look at first micro market, second futuristic building, third the tenant. So who is your final tenant? If you want to invest in an office asset, logically you should invest in office where the company or the tenant has a long-term vision for a country. So when we are seeing a lot of new leasing happening, it is more towards the global companies which have a long-term vision for India. So these 3 parts we call as a triangle theory actually can end up making a better investment decision.
Awesome. Amit, so most people will have to borrow from you to get into or buying new properties or leasing new properties from Rohit. So what is interesting in private credit today that was not there, let's say, 4 years ago?
So first of all, I think thanks to Mr. Sharma, my job is much more easier. So if you look at last 10-year Nifty CAGR, it is around 10-11%, right? It's 10%, and if you add the dividend yield, maybe it will be 11%. So, while we think that equity is the big brother and should give you higher equities, but if you look at debt has, and in fact, private credit, it can easily give you 15-16% returns, which is far superior even than debt returns, right? So that is one thing. And now that equities have cooled off, I will leave 2-3 points to ponder over. Equity is a risk money. So you have high volatility. It comes with the volatility. You have drawdowns. See, equity, you can sit at negative returns also. Whereas lot of money, whether it's India, abroad, and you have different kind of investors. You are investing at different, age, different cycles in your, career. So people look for certain kind of a regular income, fixed income, where there's a capital protection. So I think what has increased the attractiveness of private credit is the presence of an alternative, which is giving you inflation-beating returns at a much lower volatility, at a much, total principal protection. There is no question of a drawdown, and at the same time, you are kind of getting equity-like returns. So I think that is something, that has increased the attractiveness. And on top of that, most of the private credit strategies, like while you alluded to the close-ended nature, again, where they score over, some of the other strategies in the private equity space is the regular income distribution. So typically the strategies that we run, end up distributing 8 to 10% per annum kind of a return, even on a regular basis. So you are seeing regular flow. So basically, it's an income product as compared to some of the other capital appreciation products, which are high alpha, high beta, and come with an associated volatility. So I think, and again, in the recent past, the developments of the recent past have led investors to ponder over their asset portfolio allocation, because typically, while, in India, people are not that very heavy on equities, but whoever is investing in equities, I think last few years, they were, going totally for equities. It was 100% equities, and within India, equity also people are going for riskier, like small cap, mid cap. So now that I think there is some kind of a correction, what has rekindled the investor interest in alternate asset classes was also the fact that is there any alternative? People also want to, like, I go to Mr. Sharma's tweet, and what he went for was a 10 to 12% kind of fixed income kind of a, return. So we are seeing such similar of, interest even from Indian family offices, Indian HNIs, because people appreciate, while, obviously his is a unique theory, but people also appreciate that after any, if you take a commonsensical approach, after any longish period of a supernormal return, there has to be a mean reversion. Ultimately, it's all about mean reversion. So now, in case you have made, very good returns in equity, it's time to take some bets off the table and move to maybe a fixed income product which can protect your money and give you an inflation-beating return.
Interesting. I'll probably come it from the audience perspective here. One of the big challenges I have faced personally as someone who's looking to invest in funds also is the dispersion of returns, right? And that is a huge problem in the alternate space for anybody, for any family office or HNI, people like the audience who are sitting here. In stock markets, even if you're a very, very bad performing fund, you will get -2% or -3% broadly versus the index. But there's a very famous paper written by Mr. Michael Mauboussin on dispersion of returns in private markets. And that could be as big as 0% to 90%, right? The difference between a bottom decile or an average and a top decile performance is massive. And as we know, everybody cannot be above average, right? That is not mathematically possible. So when an investor comes to you, what are the 2 or 3 things about the way you invest, because of which the investor can get confidence that, okay, this could be a above average fund return?
So I think first is back to basics. So we believe that one should be true to label. So let's say if I am my performing credit fund, if I am talking about a 16% kind of a gross IRR, I think it's my first and foremost duty to try and deliver that instead of maybe upping it to 17 or 18. So I think first you have to be true to label. Second is, at least in the fixed income side, we believe return of capital is more important than return on capital. So I think if you keep these 2 basics in mind and don't try to do anything adventurous, I think you have done your job, because one of the reasons for dispersion is people trying to beat each other, trying to be there at the top. I'm saying if I've already guided my investor that I'm going to give you 16%, if I have delivered him 16%, in fact, believe you me, so I'm saying it in front of the audience. So what happens, people are say happy, even if they say, you give me 15%. The issue starts arising when to chase that, make that 16, 17 or 18, you bungle over something and then you fall to 10%, 5%, or even in certain cases, negative returns. That's when I think the dispersion starts to play out. If you do something very basic, you stick to your strategy, you stick to your philosophy, you stick to the guidance you have given to the investors, I think that's a job well done and you're home. I think there's no, so nobody's expecting, a positive surprise. I think the idea is to avoid a negative surprise.
Brilliant. I think I would request everyone to note this. In fixed income, it is not about giving negative surprise. Howard Marks says fixed income investing is a reductionist art, not a building up art. Rohit, your sector is very, very famous for all the right reasons. What are the things one should avoid in real estate fund selection when an investor, like people sitting in the audience, come and evaluate?
So, first and most important thing which an investor has to see is number one, his own asset allocation and the kind of money which is available for a longer period of time to be invested. See, here, unlike a equity scheme or equity thing, you cannot sell it in a day or here you have to play with the cycle. You have to play with the whole time period. So say example, we feel between 3 to 5 years is a typical time frame which somebody should have in his mind. So what we have seen mistake which most of the people have done is the time frame is shorter and they are investing in a long-term asset. So first is you have to match your time. Second is risk appetite. Again, the risk appetite of people are different. So there are again different risk which you can take in real estate also. So right from starting from a development risk to approval risk to a residential risk to a commercial risk and some of the new age risk like student housing, etc., which have recently come up. So first is time horizon risk, which you should match with the fund and the asset which you invest. Second is your own risk appetite. And third is, this is a little illiquid asset. So it will give a average return over a period of time. We have seen it, say, equities, we have seen between 11 to 13% is a return. Here also, actually, we have seen anything between 9 to 12% as a long-term return, which is, and it's a hedge against inflation. It is hedge against some of the equity fluctuations which are there. So technically, actually, if you see beta of a commercial asset investment, it would be zero or negative against the equities. So, we have done it for some of the REITs. If you see the REIT beta to markets, it's very low. In fact, some of the REITs have zero beta. So this asset class, you have to think as a asset allocation, risk diversification, based on your investment horizon, based on the risk appetite. You need to technically allocate a certain part of the portfolio. And based on your allocation, it should be that number which you have to decide, which as a investment managers, lot of investment managers which are doing, they actually provide that value addition, how and how much you should invest out of your total wealth into this asset class.
Great. Vignesh, what are the typical mistakes that an early stage VC fund does? We have a laundry list even at Antler, but would love to understand from you, which are the typical mistakes that one does and that can be avoided?
Okay, so see, first of all, even though we are all clubbed together as alternates, we start with a significant disadvantage, right? Because over there, at least they can say 10%, it's guaranteed, right? We can't guarantee anything. Okay, so basically what a venture capital or a private equity guy gets is high risk money, or what some of my bosses have taught me is middle finger money, right? Where you have the money to say, okay, I'm willing to take this risk. If it doesn't come back, I'm good. Okay, so to come back, can you repeat your question? Sorry.
No, my question is, what are the typical mistakes that you have,
Yeah. So, see, I think luck, actually, to be very honest, plays a significant role in return in private equity. But you can sort of de-risk yourself if you are true to your strategy, right? For one, we learned something in our fund that we should avoid FOMO or Me Too investing, where we feel, okay, 5 people are investing in Gen AI, We don't know 𝐻𝐸𝐴, but it looks like a good opportunity. You put money, you end up losing money. So that is a mistake that I consciously try to avoid. And second is, you know, a 25% IRR in private equity is very good, if you ask me, okay, in current markets. So if you are confident of saying 25% IRR, you say 25%. Don't promise the moon saying I can exceed this by 60%, you will get, see my last IPO. It's good if it happens, but the chances of it happening are already very high. So I would say keep your investors at arm's length and tell them this is what we are trying to do, this is what is possible. So second thing I would avoid is, the mistakes that I would not do is overpromise.
Overpromise.
Yeah. And the last is that if you strongly have conviction, you need to stay the course. You know, because this market is really unpredictable. Your product may do very well today. There's a lot of pivots that happen. So stay the course. If you don't stay the course, you're going to have a problem.
Very interesting. So I think you know, you have a 10% return, 10 to 12% from Amit. You have Rohit at 16 to 18%, and then Vignesh will do 25%, and 90% of the universe is at
Hopefully,
zero.
No, no, so we have
Hopefully
two
25.
strategies. We have 16% also.
Yeah, see, this is where it starts to go wrong, right? When Rohit, when they start competing with each other for returns. Interesting. Rohit, what I would like to understand, and I think this is something that we underestimate, we don't give enough credit to the macro that's been helping us, right? How much of an impact has RERA made when you think of yourself as a real estate fund manager?
So any market, to deepen any market, you have to be more disciplined, you have to be more regulated, which we have seen across so many sectors in India, if you see. This sector, which is a real estate sector, it was one of the most abused sector. It was absolutely unregulated. Anybody can become a developer. Actually, you need not any qualification. Actually, you don't require. You just can start a construction in India pre-RERA. RERA has brought discipline. It has brought accountability. It has brought data in the market. Along with that, there is a duty of a developer which has been ascertained. So today you cannot just do something without getting necessary approval from regulator. Secondly, they have stepped out also. So earlier, you need to now take all approvals and then launch a project, unlike earlier days where you could have just sold it and then purchased the land and then sold it. So with all these regulations, actually we have seen a lot of depth. The volume increase which has happened drastically. So so I will say more than 30% CAGR growth has happened after COVID, after RERA, and in the residential part. Now, because of which there's a consolidation which happened in the industry, because of which there was more investors' confidence or the developers' confidence, which has significantly improved the balance sheet of a lot of the developers. So you will be surprised, today 27% of sales happened from a marquee developer, I will say, or a category A developer rather than a B or C developers, which will further increase what we feel. And we have seen similarly, if you see in stock markets, SEBI made the volume growth which today we see in both BSE and NSE. It is because of the various regulations which SEBI has done. Similarly, we feel with these regulations, probably Indian real estate market will become much larger, much deeper, and a lot of institutional money is flowing in sector because of that reason.
So I think this is again a very, very important concept. You know, when you don't have regulations in a country in an asset class which is as large as real estate, it is very, very difficult for the organized ecosystem, and Rohit is a part of that organized ecosystem, to make any impact, right? But when regulation comes in, we call this value migration that happens from informal to formal or unregulated to regulated. And that is where, you know, Rohit is equal to any other money lender that would have been in the bylanes of Bombay. And he has the wherewithal to then fund the real estate market in a proper way. Amit, you had a very similar regime change in your sector with IBC, though there is still, the verdict is still out, whether it has worked or not, because of the number of cases that is pending and not yet concluded. But would love to understand from you, how did GST, the combination of GST, UPI and IBC has made your life easier, or this asset class better?
So it's a sea change, I would say as before IBC and after IBC. In fact, while I see a lot of Indian or people with Indian connections here, but when I'm on a roadshow outside India, we take a good, 5-10 minutes to first of all explain the IBC and what change it has had on the Indian, credit landscape. From a time when we are used to, talking about decades, people used to talk of if a father is going to file a suit, maybe the son or, the next generation is going to recover. Now, obviously, the intent is in weeks, but even accounting for all the technical delays, stuff like that, we are looking at a recovery in a year, which, which actually by any global standard is pretty good, right? Matlab, it's as good as it gets. Second, if you look at under IBC, the recovery to a fair value of an asset, again, I'm not talking about banks lending against inflation, this thing. Obviously, there's a PSU sector kind of inefficiency and stuff like that. You keep on adding interest on your, kind of principal. But recovery relative to fair value is around 83%, which is phenomenal, which means like typically in an industry or the strategy like us, where we are taking a 2.5 to 3 times security cover, even if you get it a little wrong, first of all, there's enough cushion for the time value of money, and secondly, there's enough security cushion. Secondly, again, another thing that has happened is now borrowers are afraid or promoters are afraid to lose control of their company. In India, the attitude is always like, we'll manage, chalta hai, there will be a way out, you will go litigate. So again, if you look at maybe it's the intent of the government, intent of the regulators, where they have been very proactive to amend regulation. If there has been a loophole that has been found, somebody has tried to game the system, they have been very proactive. So you will not, really come across a case where somebody, let's say, had the money, or kind of, and still kind of try to take the system for a ride. Now it is probably, situations where promoter is helpless, or there's a genuine case where you can't do anything about it, and there's a strategic that tries and comes in. So I think that is one. Secondly, now things like GST, UPI, what it has done is like, we do a lot of monitoring, through a cash flow monitoring. Earlier, when we would go to our IC, we'll speak to people, they will say, boss, in India, half of the things are off records, off books. Now, thankfully, at least at the scale at which we operate, again, we like the safety of large cap structures. So comparatively, if we are talking about a company which is dealing in a few thousand crore, and again, I'm saying commodity players, even a few thousand crores earlier would have this, parallel books, in Indian context, everyone has heard it. Now everything is passing through the books of account. GST has made that relevant. The digital payment has made it. So when we do a cash flow monitoring, the kind of controls that we are able to exercise, the kind of 360 view we are able to see the situation, the kind of proactive monitoring that we are able to do, I think it's phenomenal. And on top of that, if you lay IBC, we have had situations where if I just threaten someone, I don't see this is happening, over the next 3-6 months. You either mend your ways, you bring in equity, you do something, or maybe then I will have to take it to IBC. So we have companies, promoters voluntarily, in fact, going for trying and look for white knight and stuff like that. So as I said, IBC is like a sword which you don't wield, but the threat of wielding it itself is powerful enough.
Yeah, I think this whole load the gun but not fire has become a theme with the recent US president as well, with all his talk about tariff. But I think, just for the audience here, I would really, really like you to bring your attention to what the power of UPI is. Just not, I mean, it's just, obviously, we all know it as P2P payment, but I think, one of the companies that we are seeing make use of it in a way that's never been used before is a company called Namayatri in Bangalore. They do a 25 rupees daily auto debit to 1.5 lakh auto riders for the service they provide. Right? Just imagine 1.5 lakh auto riders get a 25 rupees daily debit from an app for the service that the company is providing, and they have a success rate of 95%. And Dinshaw sir and Shankar sir will remember that 95% match success rate was HDFC's success rate when they were hitting salary accounts, right? So that is what happens in a country like India when you remove friction in even micro payments. Even an auto driver can become a micro entrepreneur and take the formal economy's help. So imagine what the large corporates can then do. Vignesh, coming to manufacturing, which is the theme of your fund, we've seen success stories like Dixon, Apple's, obviously much before that, Maruti and Hero. What are the new sectors in manufacturing that we may not be visible to our public market eyes or the usual pink paper, which is now coming that you are seeing at your stage?
So I think today in India, manufacturing is still not to a great extent, reasonable extent, import reliant. Okay, so I think disrupting this import reliance with innovations. I can tell you one of our portfolio companies, without taking the name, the magnets that go into motors are largely imported from China. So China controls 95% of the entire supply chain, including what comes from South America, right? So Indian entrepreneur who wants to build more efficient motors, wanted to get more magnets, not getting it, so import reliance, duty, and then there's an embargo on export from China. So what they do, they go ahead and build a without magnets, right? Just using copper wires, right? So what this does, this gives efficiency to your magnets, and at the same time ensures that you're not dependent anywhere outside. You can keep your supply chain going. Motors are very critical. The air conditioner has a motor, the vehicle has a motor, your mixie grinder has a motor. All right, so I think there is significant opportunity where what is considered archaic or old industries getting disrupted, purely trying to avoid import reliance, or in terms of improving efficiency of the products coming in. So I think that's a significant opportunity where you're able to find your own strength, and that's all we are looking to invest on.
So import, working around the import.
Yeah, basically trying to be self-reliant at the same time innovating and getting products out to the market. Hard assets, just not your AI products. So I think.
Are there any new sectors that are emerging that is looking very interesting?
See, I would say this, Reliance, this EV ecosystem that is being showed up, right? So everyone sees it as an OEM, or everyone sees it as batteries largely, right? So there is an entire ancillary space that needs to adjust to this transition that is happening. So that is one thing that we see significantly. And also, you see this deep tech coming. A lot of people are innovating, but deep tech is a high failure business. Okay, so if 100 deep tech companies try, 95 fail. So these 5 companies who have actually cracked the product and who want to bring it to market, they need people like us to actually fund them. So I think the output of this deep tech wave that started, the residual that is left, that will need a lot of funding, and those companies will end up being very competitive in the manufacturing space.
Very interesting. I think the government just announced a very large fund for deep tech as well. The more you read about deep tech, the more you realize that the future wars will be fought by drones and not by pilots. So as a country, deep tech becomes like a very, very important IP to develop for you.
Yeah, but it's a high failure space. So investors should be mindful of
that. Great. Rohit, a question to you. When it comes to real estate, a lot of our net worth is actually already invested in real estate, right? So from an allocation perspective, if I have to start thinking about my total wealth, real estate may be already 30, 40, 50% for most Indians, right? How do you keep that in mind when you are making a portfolio decision about allocating to real estate?
You're correct. Actually, real estate is very close to all Indians. We love the touch, feel of the property, and we enjoy. Actually, it's a proud. Actually, in Indian emotional connect and the proud movement is too high for the properties. But when we talk about properties, actually there are 2 parts to it. One is self-consumption. So when we are talking about 20-30%, actually it include your own house where you stay. Okay, so that is an investment, but at the same time you are using it also. So whether that should be counted as an allocation towards real estate or not, my sense is little different. When we are talking about investment, it is something which you can trade, which you want to sell. Typically, we don't sell our houses so easily. So first, we should remove that while calculating the exposure towards real estate. Second is, so there are multiple ways in which you can invest in real estate. So of course, residential, then there is an office asset, which I explained. Offices are a larger part or the bigger pie of the real estate, which is not being discovered by investors because the ticket sizes are literally very large. You are not able to actually go into that asset class, which has given consistent return and growth also in last 50-20 years if we see in India. Then there are some other asset class also which is possible. Say example warehousing, which is a new thing which has taken up drastically in last 4-5 years with the e-commerce going up. Logistics, industrial housing, industrial warehousing, etc. are another high growth areas in India which has been taking there. Data center is a new buzzword which is because of the new IT Act, which will change how data is stored in India. So whether you can participate in those asset class, answer is yes, but it has to be through a fund model only because the values are much higher. So as an investor, if you want to invest, you typically have to use a fund and fund through that fund, you can invest into those assets class. So this, that's how we need to divide personal consumption and the investment separately. And again, in that there are multiple, similar to a large cap, small cap, mid cap, and other strategies. There are different strategies which you can use based on your.
Interesting, interesting. Amit, you spoke about, you also have a product which gives you regular cash flows. How do you manage that? How is that structured? And frankly, why should a corporate come to you if they're anyway going to give you coupon payments and not go to a bank?
That's a layered structure. Okay, let me take the last part first, because why should somebody pay you 15-16%? It's not a question of a coupon alone, right? So we have divided the opportunity into 3 buckets. One is a growth bucket, second is a strategic bucket, and third is an opportunistic bucket. Growth is anything where the money is going towards productive assets. So typical use cases are your cost overrun finance, last mile financing, holding company finance, mesh debt kind of structures. Strategic is anything which touches your capital tables, your acquisition finance, bridge finance, buyout of a private equity, that forms part of strategic. Opportunistic is, sponsor financing, loans against shares, or simply a cash flow mismatch. So basically what we are solving for the promoter or the borrower is, had we not stepped in, these are situations where maybe banks and NBFC would anyway not give him money, he would require to bring in equity. So typically in Indian context, promoters still look at the opportunity cost of equity as 24% or around. So he doesn't mind pay me 16-17%, whatever, we are able to get through. Now coming to your coupon part, see the way it happens, once I have solved for a need, see different situations are different. So how we are giving 8-10% regular distribution is, we don't reinvest coupon. So even if I, let's say, given him a ballooning structure, but it will be ballooning with respect to principal. So there will be always some situations where I am getting regular interest payment. Again, there could be some zero coupon, some redemption premium, but that's why we are guiding for 8-10% and not 15-16%, which is the total return. The idea is in our portfolio, you will always have 50-60% situation where some coupon is coming. So the idea is again, on 16%, 60% is roughly 10%, right? So I'm saying 50-60% you will be getting regularly accrual, and balance will be adding on to your NAV and it will be back-ended. So at all point of time, you will have these cash flows. So the idea is you are able to still get a regular distribution which is better than your fixed deposit or a debt mutual fund, while it grows and compounds later. So it's a win-win proposition. It is not that first we solve for the need of the kind of a borrower and the promoter, and then we try and fit the cash flows on that. But typically you are able to get those kind of a coupons, at least in a majority of situations. Like again, if I take case of an acquisition finance or growth capital, these are not really bullet kind of situations. There will be always the companies already generating a healthy EBITDA, healthy cash flows, which you can kind of, amortize or take over.
Got it. Interesting. I'm mindful of time, so I'm just going to ask one round of last questions to our panelist. Which is your favorite investment story that you would want to share with the audience here? And we can start with you, Vignesh. Yeah,
I think there's a company, this is not our investment, but I really liked how they went about it. There's a company called 𝐶𝐸𝐴𝐚 in Pune. Okay, so 𝐶𝐸𝐴𝐚 is set up by IITians. The early 90s IIT, he passed out. So the thing about this is they thought about, so they make electronic components for engines. Okay, so they had a theory back in college, like how this could be done better. They stuck to it. They didn't follow the dream of going abroad and living a happy life. They actually built a business. And 𝐶𝐸𝐴𝐚 is now, they had 10-15 years of strife about getting to where they need to get. Now they're ready for IPO. I think it will be a bumper IPO. So I think the company is solid. We really like what they do. So I think 𝐶𝐸𝐴𝐚 is an excellent example. People should look it up.
Interesting. Rohit.
So we have a lot of interesting
One. Both interesting.
So that's why I'm saying I have to choose one of them. See, one of the assets which we invested It was just opposite our office. So we said that we should invest in this asset. And while approving the investment, we said that because it will absolutely completely block our view. So it was just a building which will just block your view. However, we made investment still because we felt it is a good investment. And you'll be surprised, we made multiple returns on that asset, which is one of the core asset in BKC in Bandra. And we made a good return in that. So many times you have to forego your interest.
Do you remember how many times you made in how many years?
It was 4 years and we make twice.
Wow.
3 years we make twice money.
On a large pool of money.
On a large pool of money.
Nice, nice.
So point is, many times we have to stop our view in terms of not only seeing the asset, it's about the value which it will create, not for us, for all the stakeholders which is there, whether it is developer, whether the new people who will stay in that building. So it created value for everybody.
Amit.
Yeah, so if I have to choose one, I will go for GMR Airports. We started investing in that asset, when Delhi Airport had just come up. In fact, it was loss making. So whenever we would go and explain to everyone, it would be very difficult to explain why somebody is losing cash, on this thing. So we tried to explain this is a regulatory asset, how the returns are calculated. So the first time we took a holding company kind of a structure, the returns are also phenomenal. In fact, for a debt investment, the returns were upwards of 20%. Because we were solving for some real need. India is a capital scarce country. From a valuation of a couple of 1,000 crore, right now it's a listed entity, GMR Airport, the valuation is 80,000 crore. So there's been a 40x kind of a valuation that has got created. And now obviously airports is much more a story that everyone understands. In fact, one very recent transaction, just to tell you within GMR that we did was, it was post-COVID. ADP France had taken in a stake in the company, valuing it at around 15,000 crore. We went in with a 2.5x cover. Again, we were taking a call. That means on 6,000 crore. And we got a 20% IRR. And we exited in 2.5 years. And basically, it was in fact for the merger of GMR Airport into GMR Enterprises. GMR Airport was not a listed entity. So just because of collapse of structure, there was a 2x kind of a value creation. So it's a win-win situation. So we believe we are partners in growth for promoters.
Great, awesome. On that note, thank you all panelists for being, for sharing all your knowledge with us. And I hope you guys enjoyed it as much as I did. And minimum returns 12%, maximum 25%, comparable to 0%. Easy pick. Thank you so much. Have a great day ahead and a great year ahead.